started talking about Bollinger Bands. Now, in tonight's class, I'm going to use the term security, but I'm also going to use the word stocks, bonds, sometimes commodities, futures. Sometimes I'll say Bitcoin or CFDs, or I might say cryptocurrency, but I'm talking about all tradable instruments. It just gets very boring saying security, security, security. I also intermix the terms investing and trading. Now, we all know an investor takes a longer term position and a trader takes a much shorter term position. But in either case, the basic concepts and techniques we talk about in class are equally adept, but it also gets boring saying investing, 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 or trading, trading, trading. So I mix and match them. But just so you know. Now, the question is that we all want to ask is, should I buy today? Or maybe should I sell today? What will the prices be an hour from now or tomorrow or next week or next year? Wouldn't investing be easy if we knew the answers to all these seemingly simple questions? But I don't have a Ouija board and I don't have a crystal ball. And a money manager and researcher named John Bollinger. And the nice thing about Bollinger Bands is they've been around for a very, very long time and they've withstood the test of time. But Bollinger is still very active, which means that he is still updating his indicator and he's still giving us more and more information and ways to apply it. And he's adjusting it continuously to fit new kinds of markets. Like just a few years ago, as you know, cryptocurrencies didn't exist. Well, Bollinger's tested his Bollinger Bands to make sure that they work well trading with cryptocurrencies. And so far, they work extremely well, whether you're trading Forex, CFDs, whether you're trading commodities or currencies. They work in all markets. Now, the nice thing about it is there's been an abundance of information published on how to trade with Bollinger Bands. Much of it, though, is discretionary in theory. There's all types of gurus out there trying to tell you what to do. But if you want to learn right from the horse's mouth, you can go to www.bollingerbands.com and learn everything there is about Bollinger Bands directly from the developer and the inventor, John Bollinger. Very rare that this happens because most of the well-established indicators were developed, like RSI and stochastics and MACD were developed 40 and 50 years ago. Most of those people that developed them, whether it was Charles Dow back in the early 1900s or Gerald Arpel in the 1960s, they're still not active in the market or they're not even active in life anymore. Now, Bollinger Bands falls into a group of things that we call envelopes or bands. And they form a band around the price action on the charts. Now, Bollinger Bands can be applied in all financial markets, including equities, Forex, commodities, and futures. Bollinger Bands can be used in most time frames, from very short to hourly, daily, weekly, and monthly. Now, this is something you have to keep in mind because a lot of indicators do not work well in very short-term markets. They don't adjust fast enough, or they give you lots of false signals. Where Bollinger Bands works very, very well. Now, Bollinger Bands tries to answer one basic question. Are prices high or low on a relative basis? Because if prices are high on a relative basis, we want to look towards selling. If prices are low on a relative basis, we would look towards buying. So that bit of information is incredibly valuable. And it's even more powerful if combined with other tools such as other indicators for confirmation. Now, Bollinger Bands are a technical analysis tool. Specifically, they are a type of trading band or envelope. Trading bands and envelopes serve the same purpose. They provide relative definition of high and low. They also provide us pattern recognition. Bands are usually thought of as employing a measure of central tendency, as such as a baseline or a moving average. Now, Bollinger Bands use a middle band, which is called the basis band. And then it uses an upper and a lower band. These upper and lower bands are used by something called standard deviation. So Bollinger Band starts out with a typical 20-period moving average. So let's go look at this on a chart. So let me pop up a chart that I got prepared for you. Okay. So we're looking at the Euro US dollar on a current trading chart. And we're looking at a 30-minute chart, only because this is my standard teaching chart. Now, I've already put the 20-period moving average line on the chart. You can see it's this gold line, simply a moving average at a 20 period. Bollinger Band starts with this and then calculates what's called standard deviation. And that standard deviation is not a financial calculation. It is a statistical calculation. And it applies an upper and a lower band based on two standard deviations above the 20-period moving average and 2 periods below. And this gives us our Bollinger Band. And as you can see on the chart, it's got many shapes and sizes. Okay. Well, I've seen Bollinger Bands that look like aliens. I've seen Bollinger Bands that look like dragons. I've seen Bollinger Bands that look like snakes. And I've seen Bollinger Bands that look like they're pregnant. The shape of the overall Bollinger Band doesn't tell us anything. So whether you're seeing a space alien or you're seeing a snake doesn't make a difference. Now, the volatility of the markets can be seen in the width of the band. When you see a very wide band, the markets are very volatile. When you see a narrow band, the markets are very quiet. Doesn't mean whether they're an uptrend or a downtrend. It's talking about the volatility in the markets at this point, not whether the price is trending up or trending down. Because if price is trending up, like we see here, price was trending up with a beautiful trend, but the bands weren't getting any wider or narrow because the market had no volatility. It was a steady growth. Here, we see the bands very wide. We must have had some type of big drop in prices or climb in prices. But that's only a side effect of the Bollinger Band. So it's said that everything and anything you need to know about price is located between the upper and the lower band. Now, so we have our moving average, our upper band, and our lower band. And this gives us the Bollinger Band indicator. It's one of the few indicators that's actually dropped directly over price action, because most of the indicators, as you know, are below price action. And Bollinger Bands is not an oscillator. It is a true indicator. So let's go back. Before we talk about how to use it, we have to understand where it comes from, because the only way you're going to be able to spot opportunities or false information is by understanding where these lines on the chart come from. You'll never ever have to do any calculations, but you need to know where these calculations come from, because all you do is go up to indicators and click on indicators and drop on Bollinger Bands, and it's going to drop the standard Bollinger Bands onto your chart. So Bollinger Bands, as I said, starts out with the 20-period moving average. From there, it goes and puts on what we call the upper band and the lower band. And these are based on what we call standard deviation. So interesting, in the real world, no statistician would ever calculate standard deviation by hand. The calculations are involved and are somewhat complex. and risk the mistake, making a big mistake. So even statisticians only tell their spreadsheets to do a standard deviation, because a standard deviation is a standard statistical formula. Okay, it's not an adjustable formula. So standard deviation is the measure of the dispersion of a set of data from its mean. Well, in our case, the mean is the moving average, and the dispersion is the price. It is calculated as the square root of the variance by determining the variation between each data point, or in our case, each price point, relative to the mean or the moving average. If the data points are further from the moving average, there is a higher deviation within the data set. So in its simplest form, the mean is simply an average of all the data points in a given set. So if we're using a standard moving average and all the data points in that set is just the standard moving average, what do we have? We have the last 20 periods. So this can be obtained, and a moving average is obtained by just taking the last 20 closes and then dividing by 20. Because markets are fickle at best, traders and analysts use moving averages that adjust to incorporate the most updated data. This means the calculation is always taking into account the most recent session's movements, and older sessions drop off. And we use for this an exponential weighted moving average and then apply the two standard deviations. So by default, the Bollinger Bands are set to two standard deviations. Now, you're going to see all types of gurus in the market trying to tell you they use one standard deviation, they use three, but then it's no longer Bollinger Bands, it's whoever's bands they are. And unless you did all the back testing, unless you did all the research, this guru is telling you, when this happens, and that happens, do this. Well, that's no way to trade. You need to know that it's two standard deviations using a moving average of 20, and you have 50 years of research and back testing, so you know what's going to happen. So again, the standard deviation is calculated based on the average or the moving average. The distance of each data point is squared, summed, and averaged to find its variance. Or to put it another way, variance is derived by taking the mean of the data points, subtracting the mean of each data point individually, squaring each of these results, and then taking another mean of these squared. Or standard deviation is simply the square root of the variance. Okay? We've done the calculations. Never have to talk about it again. So we have the base line, or the middle band, is a 20-period moving average. We have the upper band, which is the standard deviation of two positive standard deviation, and the lower band, which is minus two standard deviations. So that gives us our upper band and our lower band and our moving average band. So we have three bands. 1, 2, 3. That's it. And the nicest thing that I like about Bollinger Bands is because it's dropped over price. You are dealing directly with price action, and you're looking at price action. Too many people use these indicators in the bottom of their charts and just see it moving up and down and pay no attention to what's really happening in price. Because Bollinger Bands is put right on a price chart and incorporated in a price chart, you're forced to be paying very close attention to the actual movement of price. Now, once we've dropped this on our charts, there are three primary ways we can use these Bollinger Bands. The first is for pattern recognition. You know, we sometimes, if you're into pattern recognition, you know we're looking for triangles, or we're looking for channels or wedges or pennants and price movement. In Bollinger Bands, we can look for what we call the M and the W. It also helps us with reversal patterns, and it also gives us trend analysis. So we have three different ways that we can apply Bollinger Bands to give us pieces of information. So there are many ways to use Bollinger Bands, but it's important to note that when the price touches the upper band, that doesn't necessarily automatically mean sell. Similarly, if the price touches the lower band, that doesn't automatically mean sell. In fact, take it from John Bollinger himself, who said, there's absolutely nothing about a tag of a band that in and of itself is a signal. Now, we have, the prices can do what we call walk the band, which is what I showed you in the uptrend on the chart before. Take it back and show it to you again. And this means that there are repeated instances of a price touching or breaking through the lower or the upper band. That's why you may want to take action when price touches either band. But before we can get into the complicated parts and just deciding whether to buy or sell, let's take a little bit of easy stuff. Okay. So what we look for is a double bottom or a double top. And these form what we call the M and the W patterns. Okay. They take a while to develop, so it's not something you have to find right away. But when they do, they give you clear-cut buy or sell pieces of information. So what we're looking for in a double bottom or a double top is the formation. They will actually form what we call an M or a W. Okay. So it's very much like when you're looking for a head and shoulders. First, you have to find the left shoulder develop, then the head, the neckline, and then you're waiting for the right shoulder. So in Bollinger Bands, what we're looking for is when we're looking at the formation of the W, we don't even care if we don't even see it till it forms what we call the N pattern. Okay. This means it made the first bottom, then so it came down to form the first leg of the N, bounced back up to create the center. Okay. We don't care if it bounced up that high, this high, or that high. Came back down to make the second bottom at the same level of the first bottom. And then when it bounces off that bottom, so you have the two bottoms, and it breaks the moving average, it's giving you a buy signal. At this point that it broke the moving average and forms the last leg of the W. First leg, second, third. This is where it starts to get important when it bounces off of there after forming the second bottom. So you don't even have to pay any attention to it. When it has the momentum to carry it above that moving average, that is then generating a buy signal for you. We have the actual reverse when we have the M formation. So the classic M top is formed by the push to a high followed by a sell-off reaction and then a test of the previous high. So we see that here, and it's exactly the opposite of the W. So here we push up, form the top, come back down to form, there isn't a neckline or anything because it's not a head and shoulders, but comes back to form the middle of the W, the middle of the M. The only thing is it's not making a new bottom. If it reaches that bottom, then it's no longer an M because then it's going to give you a TP pattern. So we're looking for up, first top, down, back up to the second top that is equal to the first top, and then coming back down. When it breaks that moving average, then it's giving you the sell signal. Oh, I can't get my marker to shut up here. There we go. So we're always looking for the formation at the end. Okay. It can be an upside down or a right side up end because it's push, ease back down, push back up. When it completes the formation of that end pattern, then you're looking for it to form the last leg, but it doesn't matter if it bounces off there until it crosses that moving average. It could do a world of things. When it crosses that moving average, then it's actually giving you the sell or the buy signal, depending whether you have the W or the M. Now, we highly recommend combining the Bollinger Band with like the RSI indicator. It's a perfect match. And then we'll be able to see for sure what is happening in the marketplaces. Then we have other things like walking the bands. Walking the bands is when the price is climbing right on the edge of the band and stays all the way up as the price is moving across the band. Hold on a second. Let's go back to a live chart and I'll try to show you this. So at this point, if we were looking at the euro US dollar way back here, okay, what we see is that the price is walking the band. See how the price and the closes of each of these prices is right on this band. That would have given us when price would have crossed over here, okay, and moved up to that band. As long as it's staying above the moving average, it's giving us a very strong buy signal. See, then when it loses that band, is rejected by the upper band, that's when we would have exited the market. Okay, we would have possibly even looked for a sell choice when it broke below the moving average at this point. Okay. So again, we have walking the bands here. Okay. Price was falling down, broke below the moving average. Okay, was rejected by the bottom. See how the lows kept trying to reach that bottom band, but couldn't. It was rejected. When it crossed above that moving average here, we would have been looking at an entry point for a buy. Now, because you can't always predict what price is doing at the moment, I've prepared a little presentation for you, and I'm going to share that with you now. That'll show you how to do this in a progressively moving chart. So hold on, let me pop that up on your screen, and then we'll go back and talk about some strategies for using Bollinger Bands in your trading.
To the live market and take a look at the pound dollar on a daily chart to illustrate how we can trade using Bollinger Bands. The upper and lower bands represent two standard deviations away from the market, and the middle band is based on a simple moving average. There are many combinations that one can use in terms of the Bollinger Bands settings. However, the default and most common settings used are a period of 20 with a deviation of 2. Bollinger Bands can be used in ranging or choppy markets, that is during times of consolidation like here, and also in trending markets. Therefore, this tool can be used by scalpers, day traders, and even long-term traders. Let's firstly take a look at how we can trade these bands in tight ranging conditions. As you can see, the market is ranging at this highlighted section. Note that price bounced between the upper and lower bands whilst it is ranging. Note that in this example, the range is small, therefore opportunities arise for both longs and shorts to be undertaken. A strategy can simply be followed by taking a short at this point. Once the price hits the upper band, placing a stop loss above the upper band here, and a profit target may be placed at the bottom band here. Once the lower band has been hit, the sell trade is closed. However, an opportunity to go long or buy arises. A buy can be executed here with a stop loss below the lower band and a profit target set at the point where the price hits the upper band. As you can see from these examples here, there were multiple trades to take both long and short. Another way to trade with Bollinger Bands is to focus on contraction and expansion. In simple terms, when the market ranges in a tight area or consolidates, it's known as contraction. Generally, what occurs in trading is when the market contracts like this, a breakout tends to follow. This is known as an expansion in the market. As you can see, the market had contracted here, then dynamically expanded to the upside, creating an uptrend. Traders can employ this strategy when trading with these bands. Traders can enter a long position once the market has broken out of the range at this point, highlighting a potential move higher. Using various tools to execute the buy once they have recognized at a point that the trade might trade higher can help determine the entry. Basic tools such as previous support as leverage or even trend line breaks can help to determine the buy. A stop to be placed below the entry at a point of tolerance, and a profit target measured by the range of the contracted area or potentially a break back below the middle band. Let's take a look at a short example. This is the ranging zone with potential for trades within the contracting period. Once the price clearly breaks out and expands to the downside, a sell can be executed, here, for example, or even here. Once the direction has been determined, in this case, to trade a sell or to go short, the entry and exit points must be managed applying a sound risk management ratio. This expansion strategy can be traded on many time frames. Let's take a look at another strategy designed to use Bollinger Bands. One of the most difficult aspects of trading is to determine the trend. In this case, we will use a certain technique with the bands to help us determine the trend. Firstly, this setup requires patience and discipline, as the bands will tell us which way we are trading, either long or short. Using candlesticks for this technique is preferred, as you can see the closing price better than any other type of chart. An understanding of price support and resistance is critical for the entry, so please visit the support and resistance modules if you haven't done so already. Let's start with buys or longs. Step 1. We need the candle to clearly close above the upper Bollinger Band line, for instance, like here. The closing price has closed above the upper band line. Please note here, if you look closely, the closing price of these candles have not closed above the upper band. Only their wicks have gone above the band, but the actual candles have closed below the upper band. So this occurring is critical, as the part of the first criteria of the trade has been met. Once we clearly see that the green candle has closed above the upper band, we must ensure that when this occurred, that a new high was also generated. For example, when the candle closed above the upper band, we also had price generate a new high. This is critical, as this part of the setup defines the direction of the trade, and that is to go long once these two elements of the trade have been met. Just to repeat that step one more time. Once the candle closes above the upper band, we must ensure that in the process a new high has also been generated. Step 2 is to look for a specific entry point, so we know when to buy. This is where previous price highs and lows come into play, as these are the points we need to use as reference to execute the order. When step 1 has been confirmed here, we need to wait for the market to retrace back to a previous high. Find a relevant high to use, then execute the buy order. For example, here. Price has acted as a magnet and retraced back to these previous price highs, paused, and continued to move higher in the uptrend. A stop loss can be tight below the previous high levels, and new highs can be targeted in terms of a profit point. Let's take a look at a sell or short trade. Let's highlight the candle that closed below the lower band, here in this example. As you can see, the market is trending down, and this red candle has closed well below the lower band. Furthermore, a new low has also been established, as you can see when we compare this low to the previous low. Once this part of the trade criteria has been met, we understand we are looking for an entry point to go short. We need to look for previous lows to act as resistance to define the entry. As you can see, we will use this low here, and once the price retraces back to this point, a sell order can be taken. A stop loss is placed back above the entry at a point of tolerance, for example, just here, and a profit target to be placed at new lows. With this technique, we are defining the trend via the Bollinger Bands, then using price levels as a form of entry and exit.
So there are just a few things that you need to pay attention to when it comes to using Bollinger Bands to analyze trend strength. Now, during strong trends, price stays close to the outer band. If price pulls away from that outer band as the trend continues, it shows fading momentum. Repeated pushes into the outer band that don't actually reach the band show a lack of power. A break of the moving average is often a signal that the trend is ending. So in this screenshot, we can see 5 different precise uses or interpretations of the Bollinger Bands and how it's reacting to the upper and the lower band, and also how it's reacting to the moving average. So as you notice, price in number 1 is in a strong downtrend, and price stays close to the outer band all the time, which would be a very bearish signal. So we can see this riding the bands down in number 1. Then, as price fails to reach the outer band and then shoots up very strongly, even showing an engulfing pattern, this is a classic reversal pattern where the bearish trend strength is fading. So we can see here, price rode down the band, then it could not, it keeps getting rejected, can't get back to that band again. Then we got our engulfing candles, and this was telling us that that downtrend is ending, but we don't have a strong buy signal, but we do have to get ready. And when it crosses this moving average, we could then look for an entry point to buy. Here again, we see price pushing up, staying above the moving average, reaches the outer band, then rejects off of, but still doesn't cross below the moving average, pushes back up and is unable to reach that upper band, comes back down, falls below that moving average, which we would have thought might have given us a sell signal, but then it turns around and moves right back above the moving average. But then gets rejected by that outer band again. Now we have the beautiful setup, because we have also the formation of our M. And then we have the beautiful setup here for when it breaks below that moving average, we would then look for a sell signal. Here we go into congestion again, and then move back above the moving average and up to the bands, rejected by the band, upper band, falls back below the moving average for a nice sell signal, and then starts moving sideways. So we can see everything, or explain everything that's happening with the Bollinger Bands. So we can look at all the price action in connection to the actual bands themselves. So as you can see, Bollinger Bands can be useful by themselves. But remember, too, that they are also can be combined with other indicators. Since they're a pure price indicator, you might want to consider combining them with volume indicators for even more depth or insight. Ultimately, there's no indicator that guarantees you'll always get in at the bottom or the top. However, Bollinger Bands, especially when paired with other indicators such as chart pattern recognition tools, you can find better trading decisions. So let me pop up a little basic strategy you might want to consider using for Bollinger Bands. I've prepared this little presentation for you. It's just a short, sweet strategy. There's actually no text to it the steps are written below the screen. Now, you don't have to follow along. If you notice on your screen, I've given you two handouts tonight. Okay. They're little on your screen with there's this handouts, and you can download those. So the first one is the what's and how's of Bollinger Bands. Actually, it has all of this explained to you with charts and text and everything else. And then I've also given you the top technical indicators. We've included in there Bollinger Bands, as well as the other indicators that you might want to use with Bollinger Bands. So you have those. Just click on the download button, download them now to whatever device you're using, because they're only available during this live class. And then you can move them around anytime, anywhere you want after the class, and use them as much as you want. So if you want, I'll play that again, and we'll just watch the steps down below, and then we'll wrap up the class after that. So basically, find the currency of the asset you want to trade. Look for it to be in a current uptrend or downtrend. Okay. Then the currency must fall back from the uptrend and touch or almost touches the bottom band. Then look for the RSI indicator. And once the price hits the lower Bollinger Band, look at the RSI indicator, and it should be between 30 and 50 and rising. After price hits the lower Bollinger Band and RSI is going back upward, get ready to make your entry. And then set your take loss as stop loss and take profit points. So again, find an asset that is an uptrend or a downtrend. The asset must fall back from the uptrend and touches or almost touches the bottom band. Once the price hits the lower Bollinger Band, look at the RSI indicator, and it should be between 30 and 50, 30 to 50 and rising. And after the price hits the lower Bollinger Band and RSI is going upward, make your entry. You can make the entry when you see either a strong bullish candle to the upside or you see consecutive reversal candles to the upside. Now, all of this is explained in that handout for you. So Bollinger Bands are a great indicator to use in any market. When you combine these with RSI indicator, it should give you a great entry point. So something else you might consider is when price touches the middle band, you can make a second entry to press your winners. This can potentially give you double your profit. With this strategy, we only use one trade that we initially make. But if your rules allow you to make multiple trades at a time with the same currency pair, then adding a second position at the middle line may be something you would want to consider. So as you can see, Bollinger Bands is a very good indicator that helps you analyze price action, gives you entry points, exit points, stop loss levels, helps you evaluate the trend and see potential trades. It's not very complicated to use, and with a little bit of practice, in no time at all, you can be incorporating Bollinger Bands into your trading. So please remember to download those 2 handouts I gave you, and all of this will be explained in great detail in those handouts, and then you can start using Bollinger Bands in your trading. If you have any questions, just contact LegacyFx. They have a whole bunch of education sections. They'll also help you with a one-on-one financial analyst and enroll in their education in their academy. So thank you very much for joining us. And remember, LegacyFx, www.legacyfx.com. And you can go right now and open up a demo account and start trying out Bollinger Bands right there tonight. So thank you very much for joining us and have a great trading week.